skip over it and just do 1-2 lines and then we are done. But okay. Why is this thing trying to embarrass me after such a beautiful intro? I can't be embarrassed. Hallelujah. Are you guys ready? Okay, I see the timer. Be greeted in the wonderful name of my Lord and Savior, Jesus Christ. Amen. Amen. It's good to see young people in the room. And first of all, I'll just like to thank the leadership for this opportunity. I think I have a very interesting task today. So my session will be a bit interactive given how much information is on the slides. And once again, the book that they were talking about that I authored is this book, and a lot of the information that you will find on the slides was sourced from the book as well. So may I ask the people at the back, you seem far, hey? Can we just clap hands for them to come and feel? We want you to be a part of us. Come on, we want you to be a part of us. You guys are already eating into my 35 minutes now. This is okay. So today we are, I think we can start projecting the slides. Today we are going on a bit of a deep dive on the stock market, but specifically just exploring the investment landscape in South Africa. How many of us are actually investors in the room? Okay, we have a bit of work. Out of the people who raised their hands, how many of us actually know what we're doing when we're investing? There's a difference. No, is it up? Oh, okay, a bit. Okay, cool. And for the people that haven't started investing, why haven't you started investing? It must be quick because I have 35 minutes, so let's go. Interactive, why haven't you started?
I don't know, maybe I don't know the difference between saving and investment, but I'm saving.
You are saving, but you're not investing. Yes. Okay, cool. Any other person? You don't have money. Interesting. That's a very interesting answer. Cool. Over there. The risk. Okay, cool. Another person? Last one? You don't know what to invest in. Okay, amazing. I'm glad that at least my presentation will be useful tonight. And in terms of just saving versus investing, right? Saving, you're setting aside money for a specific purpose. You're not trying to grow it. You're setting it aside because there's something that you want to do. Investing, you basically want to grow your money. You want your money to work for you. That's the main difference. And I guess it comes into, we will get into it in the presentation in terms of when you want to save, where do you go? When you want to invest, where do you go? And I mean, we do have to appreciate the level of risk that comes with investing. But I mean, there are some vehicles that are low risk, other are medium, and then there's high risk, and then there's like very high risk, but all of that is covered in the presentation. So, second slide. What is the stock exchange? I mean, we've all seen that Johannesburg Stock Exchange building in Sandton, right? Yeah, so what is the stock exchange? What is it? I mean, you guys are conquering the edge. I expect more energy from this. How would you define the stock exchange? Anyone studying economics here? Okay. Okay, it's a market. Yeah, I'll take that. They're coming to invest, yes. Anybody else? Any ideas? I mean, I put spaghetti there for a reason. So I had this interesting idea of explaining to you what a stock exchange is using like spaghetti. Do we have any spaghetti lovers in the room?
Yes.
Okay, interesting. So basically, imagine you are going to a favorite restaurant that serves the best spaghetti in town, right? That will be Paul's for me. You get into Paul's. What do you do when you are by Paul's? You walk in, a waiter will meet you probably by the door. They will show you a table for you to sit. And then they'll probably ask if you want water or you want anything to drink. And they will give you a menu. From the menu, you will then browse through and decide what you want to have. They'll take your order, send it to the kitchen, and the kitchen will prepare whatever order that you basically put through. And after the food is cooked, they will bring back the order to you and you'll start enjoying your meal. And then when you are done, if the meal is delicious, you'll be generous on your tip. It'll be more than 10%. And then you'll also pay for your meal as well. So in this scenario, in us trying to unpack how the stock exchange works, basically you, in this scenario, you are an investor. The waiter is a broker, so an employer to the stock exchange. And they come and take your order, so you invest with them. When you're in a restaurant, you don't go straight to the kitchen and say, hey, I want spaghetti meatballs. You have a waiter that comes, takes your order, takes it back to the kitchen, and the kitchen, that's the exchange within the stock exchange. So what they're trying to do is to match whatever people want to buy versus what other people want to sell. So it could be other people who are selling or other companies that are selling. Their main job is to make sure that for the demand of shares or whatever asset that they're selling, there is another buyer on the other side to basically buy the item that is being sold. And then we have your waiter. We said that that's your broker. And the bill that you basically pay at the end of the day, that's the price you will pay for the instrument you want. Let's just simplify it and say shares. So you will then take the shares, you'll pay for the price of the shares. If the demand is high for spaghetti meatballs on the day, well, they don't do this in restaurants, but like the price will go up because everybody wants spaghetti meatballs. But if the demand is low, then the price will be a bit low. It will reflect that in the pricing. At the end of the day, when you tip, the tip that we spoke about, those, we can think of those as, transactional fees and other management fees that they charge you. So in a nutshell, it's just a regulated market, as the lady over there expressed. Is it clear? So if I say spaghetti meatballs, you can explain to me what a stock exchange is and how it works. What's a waiter? Okay, we got it. What's a tip? Transactional fees. Okay, what's a bill, my brother? The price for the shares or whatever assets you're buying. So just think about the meal. And of course, in the menu that they gave you, right, there are different options. So the same when you go to the Johannesburg Stock Exchange, there are different shares that you can buy from different companies, like listed companies. So think of it as that. So now when someone asks you what a stock exchange is, just tell them spaghetti meatballs. Okay, I'm still doing good on time. I love this. So the person who invited me said I must discuss the different trading platforms that are available, right? And I think the most famous one that everybody, when they think about trading, they think about Easy Equities. And they've built like a very strong brand in the South African market in terms of investments and all of that. And they've got a whole lot of things that you can invest in there, whether you're going for specific company shares or you want to buy ETFs and all of that, it's all in there. So what I did was to just try compile a list of other options because we tend to be a bit biased around where we invest our money. But especially as young people, when you start out with investment, most of the time you don't know what you're doing. So I like to basically split the whole investing game into two. To say there's direct investment, where you basically take your money and you buy, you literally select what stock you're gonna buy, select what company and all of that, and you invest your money in that. You are basically the portfolio manager or the broker in this situation. And you will do that via the different apps. So there's Easy Equities, there's like Easy Crypto, there's the Satrix. Satrix also has its own app. All of these apps that you can use to basically invest for yourself. But the main challenge there is, of course, when do you buy? What do you buy? How much do you buy? How does the process, go on? But it's a good practice to just, if you want to learn a bit, lose money a bit, pay school fees as they call them, it's a good place to start. But I wouldn't advise like you going out and basically taking out all your life savings and gambling with them because you don't know what you're doing. Chances are you might end up losing your money. But there are other companies in the market, right, which help you with investing. So we can bring back the whole example of a waiter. So you would go to these companies that we call investment companies or asset managers and say, hey, I've got this much amount of money that I would like to invest. It doesn't have to be much. Sometimes there might be on some, you can put down 10K or 20K, and then on a monthly basis, you might decide to add on top of that. So these companies is the likes of your Allen Gray, your PSG, your Rensis, but the Rensis one are more for the higher up, the people who are already, they've arrived. They cater for those sophisticated people, which you guys will be one day. Then there's Signia, and then you also have 91, which was previously called the Investec Asset Management. Then within the banks as well, you've got Standard Bank. They have their own online trading platform. So different banks as well. Absa, they've got their own Absa Stock Exchange. There's now Outvest as well, which was recently acquired by Alex Forbes. So all these different venues or all these different platforms can essentially help you if you want to start your investment journey. So the first part is deciding which one to go with here, which is of course going to be a difficult, decision. And I can assume chances are you're all going to start with Easy Equities because that's the one, you're familiar with. But it's also good to just download the other apps as well and explore and see what's inside and what is it that, they offer that Easy Equities doesn't necessarily offer. And if you're someone who's into risk, the Luno app as well for your crypto stuff, you can dab in there and try to see how it is. But it's also important to also know what you are investing in and how you're going to do it. So out of all these platforms that are here, which one would you go to if you want to invest in bonds? Bonds. Which one? No, I feel like you guys are cheating because the answer is there on the screen. But okay, so you would definitely go and invest in the retail savings bonds for, the South African bonds, basically, the South African government bonds. And what is a bond? Because I think we're using big terms here. What is a bond? No, not a bond of a house. It's the government of South Africa doesn't have a house, so it can't be the bond of the house. But that was a nice one. Okay. Yes. 100%. So at least if you want to know what a bond is, it's not a house bond, it's not a mortgage bond. But I mean, you're not wrong. Technically, you're not wrong, but for this context, you are, right? So the gentleman explained it well over there. So you can also invest in retail bonds as well. And I think when you go to their website, I love how they explain the whole process, like step by step, so you can see what you need to do. And you can invest as little as like 1,000 rands for South African retail bonds, which I think can be accommodative to someone who's a student as well. To just see, maybe you can start with, 12 months one, 3 years, 5 years, just to see how it goes. And the thing about investing is it's also not an exact science, right? There's a bit of, you having experience, and how you will normally gain the experience, especially as a student, would be by you going out, trying to invest in these different things so that you get a feel of how they actually work. But at the same time, not taking all your life savings and putting them in there because you are still learning. But over time, once you sort of know what works and what doesn't work for you, then you can gain the confidence to actually, do your own investments. But I mean, I'm even at this point, I don't do all my investments directly. The stuff that I know is important, or a huge chunk of my investments on a monthly basis, I hand that over to 91 to say, guys, manage this for me. And then there's, little sums of money that on a monthly basis, I'll be like, actually, crypto has been doing well recently for people who are investing in crypto. So you'd put it in there and see, like, what happens and learn. Sometimes you lose money, other times you make money, other times you just buy and you hold for a long period of time. But it helps because over time you sort of know, I must not buy when everybody's going in because the price is like up there. I must have money so that when things seem like they're dipping, but these are companies that are reputable, I can put my money in there knowing that they'll recover and I'll make more money. So it's things like that you sort of learn as you go. But the main thing is you have to start and explore. It cannot come by you just listening to other people telling you about investments. It has to be you, even if it's 50 rands and you put it in your Easy Equities app and you start seeing how things are playing out, it can go a long way because it teaches you now to start seeing, you'll be monitoring stocks before you know it. If you know you've invested in a certain company, I'm telling you, you'll be opening that app and seeing, how are we doing, Sometimes you make good picks and they go up. Other times you'll just see like it's just going down. And that's part of the school fees. The whole thing is don't panic. Just let the play unfold, right? And see how it goes. And then you might be lucky if they recover. I mean, if you don't recover, then it might be a situation of you have learned or you've paid your school fees. You will know how to pick better next time. But that's investing and risk. And is there any company on the slide that you guys are interested in before I pass on to the next slide? So don't worry about taking down the names and things. I will share the presentation afterwards. Are we good here? We can move on. Okay, perfect. So now, I think we will spend quite a bit of our time here just analyzing the different investment vehicles, right? So I've sort of placed it from low risk, medium risk, high risk, very high risk. And so, can you guys see? Yes. So let's start with the low risk, low returns, right? What's a money market instrument, money market account? Not the one that you used to send money, like cash send, not that one. But what's a money market investment account? Have you guys ever heard of a money market investment account? Okay, the lady over there is saying yes. Can you explain it to us? You forgot. Okay, interesting. Anyone who knows what a money market instrument is, money market account is? Nobody. This is quite interesting. Okay, anybody who knows a savings account? I'm sure. You are saving in your savings account. Perfect. And then what about retail savings bonds? I mean, we've covered this one. So technically everybody should know this one, right? And then what about fixed deposits? I mean, these are a form of your savings account. So here what you are really doing, for majority of these, like your savings account, your fixed deposits, you would normally use those for savings. And you wouldn't expect to double your money or even get like returns higher than 8% on these because, it's sort of like your very safe sort of investment vehicles, savings vehicles. And with these ones, you put your money there, you're going to sleep well because there's no way you're going to lose your money. Yes. But the downside is the more safety you have in terms of you're not going to lose your money, it means the return is also going to be very safe. So it works like that, we will reward you for taking on more risk. And then when it comes to, your retail savings bond, your money market account, those two, I would classify those as more investment vehicles rather than necessarily, savings vehicles. But they're also pretty safe, right? I would also add in things like your tax-free savings account in the same category with your money market account and your retail, basically, savings bond. So with your money market account, basically, it's like think of it as, it's a savings account that gives you a bit higher sort of interest, right? Or a higher return compared to what you would generally get from a normal savings account. And they invest in very short term. They take your money and they invest that in very short term investment vehicles, right? So when I lose you, you must just let me know. They invest that in very short-term investment vehicles. So treasury bills, they'll invest in something like that. Or, your very short-term bonds as well, they'll invest in that. But the good thing here is chances of you losing your money also very slim. But you have the upside of, you can get
returns that are a bit higher. And at the same time, some banks I've seen, they've got limits in terms of you need to put in 20,000 rands and above. Normally that will be the requirement, which with a normal savings account, they wouldn't have those requirements. But with a money market account, they might say the balance in your account must be 20K and above for you to be able to earn returns. If it's not, if it's below that, then your money just chills there without earning returns. So that's the tricky part in terms of these accounts, but generally very safe. So are we all clear?
Yes. Cool. And then you've got medium risk, medium return. So you can see as we move to the right, as you take on more risk, the reward is also, increasing. So here I've put in government bonds. I mean, we always say the government is risk-free for those who do ecos, but is it really risk-free? Because we've seen there are governments that have failed in the past. But anyways, we're saying if you invest your money in the government, chances are you're going to get it back. Maybe not 100%, but you are going to get it back one way or the other. And then you've got your balanced unit trust. You have your blue chip companies. What's a blue chip company? Because I feel like there's so many terms on the slide. What's a blue chip company? We don't have eco students in here. Oh, accounting.
Yeah, chairperson.
Chairperson, what's a blue chip company? My chairperson, the fellowship is depending on you.
Yeah, chairperson.
Chairperson, you're a man of leadership. Chairperson, blue chip companies. I feel like there's ChatGPT somewhere here, but anyways, yes. ChatGPT's. What are you saying, my sister? I think you're on the right track. You are definitely on the right track in terms of it being a blue chip. But the returns and the money market, I didn't catch that part. You're definitely in the right direction. Anyone to add on that? You can simplify it. Chairperson? Come on, Chair. You don't know? Okay, you're back.
They are rated lower, right?
Yes.
Compared to others. And so I guess the return is lower. This is what I think.
Okay. Yeah, well established. Yes. Okay. ShopRite. Yeah, MTN. Yeah, the big ones. Is it Google or it's coming? Oh, okay. Yeah, okay, cool. So basically this would be your safe companies. It's companies that you know, right? They are rated highly. So what she was referring to there was the credit ratings that we give different companies, right? To say these ones, if they take money from you, they're likely to bring it back, or then they'll be rated lower. If I don't really know if we would say rated lower, but okay. They may not be technical, but they will have a good credit rating to say, these ones, when they take money from you, they will bring it back. These ones, if they take money from you, chances are they might not bring it back because something might happen. And so you are taking on that risk, so you need to be compensated for that risk. So a homework could be going to investigate what blue chip companies are there in South Africa. And as your trial and error in investing, you can start with those because they are relatively safe. And another option would be to start exploring companies that, give you dividends on an annual basis. Then you'll get excited when they send you a notification to say you're getting a dividend. That's also exciting. So then we have a balanced unit trust. What's a unit trust? Because I think these terms, once we break them down, even when you see it, you'll be able to say, I know what this is. What's a unit trust? No, definitely not a trust fund, but I see where you're going. Definitely not a trust fund, but I see where you're going. Quickly, guys, I've got a few minutes left. A unit trust. Should I bring another spaghetti meatballs explanation? Okay, but basically with the unit trust, you've got a couple of people, so all of us, coming together, pooling funds, different amounts, and then we have a pot that has different units. So if you put in 1 rand, you get 1 unit. If someone puts 2 rands, they might get 2 units. Think of it that way. So we are holding basically different percentages of this basket. At the end of the day, it's all our money. This basket is all our money pulled together. And the company who handles this basket will go out and invest in different things. So with your balanced sort of unit trust, they will try to diversify the investments as much as possible so that the risk that you guys are faced with is a bit lower. Then you also have like very high risk type of unit trust that will go out and invest in risky type of assets. And then you've got medium where it's like, okay, it's not low, but it's not necessarily high. It's somewhere in between. So at the end of the day, you can cash in your units. And these unit trusts, what's interesting is because we are pulling funds from so many different people, we can go out and buy a mall, which one person wouldn't be able to do with their limited funds. But with the power of us putting our money collectively, we are able to then buy different things. So you have to, if you Google these balanced unit trust or high risk unit trust, you will see that they have their own investment spec in terms of what they invest in, the type of assets or the type of industries that they invest in. And so it's quite an interesting read to look into to say, okay, if I'm invested in this balanced unit trust, where is my money going? Because you won't necessarily know where it's going unless if you read or they explain to you. So that's also another interesting one. And then you've got high risk, high return. So here you've entered into the territory basically that says, you know, as much as the return is high, I'm also willing to lose my money in these kind of assets as well. As much as, you know, the returns can go up, it's also possible that, you know, things can be like, assets can perform poorly and you might see the balances going down and you might see the negative 6%, negative 8% appearing on your portfolio. But normally your high growth focused unit trust, so just the opposite, you know, sector specific exchange traded funds, and then you've got small medium cap JSE shares. So you've got blue chip, then you've got the small medium companies. So these are like young upcoming companies. You don't know, it might succeed, it might not succeed. So there is risk in that. And then you've got corporate bonds, right? So how does a corporate bond differ from a government bond? Yeah, see, okay. At least we now know it's no longer a house bond.
Yeah.
There's progress. And then the last one, you have your very high risk volatile return, right? So cryptocurrencies, penny stocks. Do you guys watch Netflix documentary? There was a Netflix documentary on penny stocks in America. It was basically all the gaming, it was a specific gaming company. And this guy decided to take all his life savings and he put it in that stock because he believed, so penny, it's undervalued. He believed it was undervalued and he started blogging about it, told all the other people about it as well, and people started investing in it. And other big companies, blue chip companies, were actually found trembling because people were demanding basically a penny company's shares compared to their shares. And it was a whole thing. It's so interesting. If you really want to get into investing, I think you must watch that as well. So yeah, and then you've got commodity speculation. You spoke about rands, you spoke about pounds, but you can also invest in gold and oil and all these other things as well. So these are very shaky because we know with oil, the wars and everything, they are heavily impacted. So definitely politics play a big role in basically what happens to these commodity prices. If they just say we are closing the, what is it called? The what of Hamas? The one there at the top. Guys. No, not Gaza. The pathway where oil barrels and ships basically pass through. If they close that, they were threatening to close it earlier this year. But anyways, you'll read the news. If you get into it, there's high risk based on what's happening in the world, and oil prices can be impacted, and petrol prices and all these other prices because of, say, shortage of supply.
So when you are investing as an investor, there are people who are naturally risk averse, and they would generally tend to invest in your very low risk, type of investments. But I think the disadvantage with that is then your money doesn't actually grow because your returns are very safe, as you are very safe, right? And then there are people who are on the other side as well, who are very risk seeking, and they will just say, my whole portfolio is cryptocurrency, and it goes tomorrow, and they're also done. So there has to be a balance in terms of, as much as your portfolio can have a bit of low risk kind of vehicles, try to diversify as well. Don't hold full high risk instruments. Try diversify it. Have medium, have high, have low, so that should something go wrong in one of your portfolios, then you sort of know that another asset or another share in your portfolio can pick you up. Also, don't go invest in one industry. What if that industry faces strike tomorrow and all the companies are taking, and then that thing prolongs? So you also need to think about that. But there is a slide that's coming just around, how do you end up building a well-diversified portfolio? So one, defining your goals and risk tolerance. There are some people who will just never invest in crypto because they're like, my heart cannot take it. I can't take, Yeah, there are people who are like that, and that's okay. But I mean, it's also a thing of, don't be a person now who's also very safe and you like, I will only put my money in the bank in a fixed deposit account, regardless of how much it is. So it has to be a balance, but I think you first have to define, what are you trying to do? Other people, as they're playing, it can be a thing of, I basically want to invest in a stock that I think in the next couple of months will go up and I will cash out. So that's more speculation. I will cash out when I make more money. Other people, I will buy and I will hold for a long term. Other people can be, I'm buying only, companies in different sectors that give me dividends. Other people might be, I'm investing in companies that I believe will grow over time, so growth companies. So under basically point one, you try to find what works for you. And even when you go online to say, what's my risk tolerance? Am I risk averse, risk seeking? They have questionnaires that can help you sort of see where you are in terms of the spectrum. And that can help you when you're building your portfolio. And then allocating assets across different classes. Yeah, mix match. Don't just go shares and then stay there. Explore other things, There are, of course, ETFs. There are other things, unit trust and all of that. Try hold different things. There are physical shares that you can, physical assets that you can buy, like properties and all of that, for when you guys are having money, when you have money and all of that. So that's also important. And you need to also diversify, right? So when you're diversifying, I touched on this, mixing different sectors, geographies. You can be in South Africa, investing abroad as well. Easy Equities also gives you that option. So not only are you exposed to what's happening in South Africa, then you can also try and mix match that with what's happening in other countries, and also using, cost as well, because at the end of the day, if the fees are high for managing your investments, your returns will be reduced by the fees. So it's always important to understand, how much am I paying? Am I paying 1% of my whatever total that I've invested? Are there any other additional fees? And so when you even having these conversations, you should be asking all those kind of questions. And then review and rebalance over time. Like after a year, look at your portfolio, see what worked, what didn't work, dump what you need to dump, put on what you need to put on. And then lastly, in my last 1 minute, 30 seconds, 10 golden rules of investments, basically. One, it's not an exact science, I think I mentioned this. Have an emergency fund first. So emergency fund, basically savings for emergencies. Have that at least, so that you're not putting your emergency funds in your Easy Equities account, because the day where you need that money might not necessarily be easily available or accessible. So have your own emergency fund, set it aside, and then buy quality during recessions. I think this works for me all the time. Or when something weird happens. I mean, there are things like Sasol. Weird things happen, people are striking, the share price will immediately react to it. But blue chip, this one is gonna go up. So it's things like that where you need to take advantage of like those down moments basically, but it needs you to also have money sort of waiting for you to go in. Otherwise, you're going to miss the window. Or even when the economy is just not doing well and then all the companies are not doing well, also a good opportunity. Don't chase hype, like social media hype and all of that, because when everybody starts demanding the same thing, the price goes up. So also, it must then be aligned to what you were trying to do to begin with, and not necessarily, oh, because my friend bought this, I'm also buying it, whereas it doesn't align with you, your risk appetite, and your goals. And then watch interest cycles as well, right? Right now, are we in an increasing or decreasing, oh wow, my time is up. Are we in an increasing or decreasing interest cycle? Decreasing. So which companies do you think are perfect? Which companies do you think are perfect for you to invest in right now? What kind of companies? Okay, I'll give you options, right? You've got banks, insurance companies, you've got property companies, you've got, okay, let's deal with these three. So which one of these three do you think is actually, now that we're in a decreasing interest cycle, which one do you think can make you money? Okay, that's a good one. Oh, you guys are ready. And then the last one, diversify your portfolio, not putting all your eggs in one basket. Never invest in what you don't understand. Very important, because you will be scammed. Reinvest your earnings. If you're getting dividends, just add them in there. Highly recommended. Don't invest money you can't afford to lose, because it is possible that you might lose it. And also keep your costs low and returns high. And thank you.